Welcome to Tesla Deep Dives.
The pivotal topic on our agenda today is BYD versus Tesla, the strategic divergence and supply chain mastery that redefined the global EV race. The global EV race has a new leader. The pivotal moment arrived in Q4 2023, when China's BYD, for the first time, surpassed Tesla in global quarterly battery electric vehicle, BEV, sales, delivering 526,409 units compared to Tesla's 484,507. This shift culminated in BYD becoming the full-year global BEV sales leader in 2025, with 2.26 million units, while Tesla delivered 1.64 million, marking an 8% annual decline for the U.S. giant. This seismic shift in the EV hierarchy is rooted in two fundamentally divergent business models: BYD's manufacturing first, cost of scale, and Tesla's software first, autonomy as margin. The contrast is a direct challenge to the early narrative of the EV age. It evokes a quote from CEO Elon Musk in 2011, who, when asked about BYD, laughed and stated, "I don't think they have a great product," a clip now heavily circulated on social platforms like X and investor forums as the narrative flips.
BYD's strategic mastery lies in its deep vertical integration. Unlike Tesla, which sources most of its battery cells externally, BYD produces its own proprietary blade batteries, electric motors, power electronics, and even semiconductors in-house through subsidiaries like FinDreams. This industrial superpower approach provides a staggering cost advantage, estimated to be 15 to 30% lower than Tesla's on a per-vehicle basis, with battery cell costs reportedly as low as RMB 0.4 per watt. This cost control, supported by an aggressive R&D investment, which hit 6.57% of revenue in 2023, allows BYD to dominate the mass market. BYD's dual-platform strategy, selling both BEVs and plug-in hybrid electric vehicles, PHEVs, allowed it to sell a record 4.6 million new energy vehicles, NEVs, globally in 2025. The model is a global market share land grab, enabling a strategy of deliberately sacrificing short-term profits to capture long-term market dominance, according to analyst reports. In stark contrast, Tesla's strategy hinges on an unprecedented bet on software and future technology. While it leverages manufacturing innovation, like gigacasting, to simplify production, its core value proposition is the high-margin revenue potential from full self-driving, FSD, and the eventual launch of the robotaxi network. CEO Elon Musk has tied the company's long-term value to this, predicting the total market cap could exceed Apple and Aramco combined. Bullish analysts such as Dan Ives of Wedbush Securities continue to project that Tesla will dominate 70%.
The financial results highlight the trade-off. While BYD's H1 2025 revenue surged to $51.9 billion, surpassing Tesla's $41.8 billion for the first time, its second quarter net profit dropped 30% year-on-year due to intense price wars. BYD's Q2 gross margin compressed to a three-year low of 16.3%, following price cuts of up to 34% across 20 models. This volume for margin trade is a crucial indicator of the manufacturing economics paradigm, where BYD's industrial scale is forcing price erosion globally.
Financial analyst opinion is sharply polarized. Bullish BYD analysts, often calling the firm the anti-Tesla on investment platforms like Seeking Alpha, tout its under-promise and over-deliver track record and point out its significantly cheaper valuation, trading at approximately 31 times net profits versus Tesla's lofty 83 times. They view the firm as a stable, mass-market growth play. However, this skeptical view on BYD focuses on the inherent China risk and the domestic price involution, which has seen its growth slow to its weakest pace in 5 years, signaling technological convergence is eroding its pricing premium. For Tesla, the skeptical view points to delayed product launches and declining global market share, with European sales dropping sharply, e.g. a 40% decline in July 2025, partly citing the effect of CEO Musk's polarizing political involvement on the brand's reputation. The current market sentiment, while still granting Tesla a substantial valuation premium for its AI vision, is increasingly weighted toward BYD's success in manufacturing economics. This is reflected in the tangible data.
BYD's overseas wholesale volumes more than doubled in Q2 2025, driven by a staggering 272% year-on-year surge in European sales in September 2025 alone.
Looking forward, investors must monitor two distinct leading indicators. For BYD, it is the success of its localized production in new markets, like its upcoming factory in Szeged, Hungary, and whether it can sustain its impressive 150.7% year-over-year export growth seen in 2025. For Tesla, the critical metric is the adoption rate of FSD and the successful mass market ramp-up of the $25,000 next-generation vehicle, or the robotaxi service, which, if delayed, will further erode the company's valuation thesis and enable BYD to consolidate its lead in absolute volume.
Let me know what your thoughts and leave your comments. Thank you for joining us for this crucial deep dive. To ensure you never miss a pivotal analysis, please like the video, subscribe to the Tesla Deep Dives channel, and hit the notification bell. Your engagement fuels our critical research.